Hello, my name is Mike Smith. I'm the president and founder of T&K Futures and Options Incorporated, and today's video lesson is about how to set a price floor if you're a hedger, a producer hedger, using options. But before we get started, let's go ahead and cover the risk. Futures and options investing carries significant risk of loss and is not suitable for some investors. Past performance is not indicative of future results, and you should only use risk capital when investing in these types of markets. You know, over the 20 years or so that I've been a commodity trader, I've dealt with a lot of farmers and ranchers and just a lot of different people that commodities is their living. And they hear stories about using futures to hedge, locking in a price, and how, let's say they were a producer and they want the price to go up, how they lock in at this price, and wouldn't you know it, the market that they produce, let's say it's corn, ends up going through the roof and they miss out on all that profit potential. Well, using options, you can actually benefit from a big move to the upside if you're a producer, and also set yourself a price floor to the bottom. And I really just want to show you how to do that. It doesn't matter what you are either, what you're producing. It could be gold, you could have a gold mine, you could be a cattle rancher, you think about it, farmer, anything you want. You can plug in this formula and make it work for you, whatever it is you're trying to hedge. I'm just going to use the corn because I trade grain markets mostly. Okay, so here's your formula for setting a price floor. It's what your strike price plus the basis. Basis is the difference between the futures and the cash price of whatever the commodity is, plus your premium that you pay and whatever commissions and fees you are. That's how you get to a price floor. Okay, for this example, here's our assumptions. I'm assuming it's a corn farmer that we're dealing with, and he's going to produce 5,000 bushels on his farm this year, is what he expects. And he wants to hedge that, and we're also going to assume that the price of corn is $5 a bushel. This is all made up, it's not $5 a bushel here today. And we're also making this up. We're going to say that his expected basis is going to be 6 cents. And we're going to also assume that the premium plus his commissions and fees for an at-the-money put option is going to be 30 cents. Okay, so let's plug this in and see how it works. All right. Well, here's your $5 strike price for the put. You got to add the 6 cents of basis, which is going to be your difference between the estimated basis, and then you back out your 30 cents that you had to pay for the actual hedge itself for the $5 put. Well, what this equals is $4.76. So you actually set a price floor. Your worst case scenario here, you're setting this price floor, is getting $4.76 for your corn. At expiration of this when you get out of your corn. So let's just presume this is a December contract. All right, then let's do an example. Let's say you put this hedge on, and here it is. It's December corn, and let's say the options expire November 21st, and you want to get rid of your corn, your physical corn. Okay. Let's say that the futures price is at $4.40 at this point, so the market's come down 60 cents. All right. So the difference between $5 and $5.40 is 60 cents. That's the intrinsic value you now have. That's how much your option is in the money. You got to back out what you paid for the thing, which was 30 cents, right? So that gives you 30 cents left over. 60 minus 30 is 30. You got to add your basis to that, which we estimated would be 6 cents for this example. So you got 36 cents there, plus what the market's at. The futures market is 440. Your floor still works at 476. Doesn't matter. So even if it went down $2, you still set your floor of 476. That's your worst case scenario that you're going to get for your corn by using these options. Now on the upside, market, say, goes up $1 to the upside, well, the price of your hedge was 30 cents. You're not getting that back. You bought and paid for that. That's like your insurance policy on your car. You pay a premium every month. You're not getting it back unless you get into an accident. So it's kind of the same theory here. You bought your insurance policy, cost you 30 cents. But the good news is, if corn went up $1, well, you know, back out your 30 cents, that's 70 cents more, you know, than you would have gotten if you locked in with a futures. Because if you locked in at a futures at $5, you're locked in at this point. You can't get anything to the upside with your short futures. In fact, you might have to keep feeding margin to it as the market rises, and same thing to the downside. So you're making money as the market goes down in your futures, as you're losing it in your physical commodity, in the corn for this instance. So, and like I said, plug in whatever you want for a price. You know your formula. It doesn't matter what you're trying to hedge. Just plug it in. Whether it's live cattle you want to hedge, whether it's gold, copper, oil. Well, say you're an oil producer out in Texas. Doesn't matter. You can use options to set a price floor for basically any of these commodities. But so that's a producer hedger. That's if you're producing it. If you're a consumer hedger, you know it's going to be the opposite. It's on the other side. But maybe I'll cover that in another lesson. But all right, I think I covered everything I wanted to. If you want to contact me, if you have any questions, you can go to tkfutures.com. My name again is Mike Smith. My contact information's there. I wrote a book that is available on Amazon.com that is all about options trading, and I have a whole section there on hedging, consumer hedging and producer hedging. So you can get that on Amazon.com. It's called the No Nonsense Guide to Buying and Selling Options. Another thing you could do, we offer practice accounts, these demo accounts. It'll give you $50,000 of virtual fake assets to trade, so you can practice these trades. You know, you could do the futures or the options, whatever you wanted to do, but you can actually practice, you know, with our platform, with all the bells and whistles, before you put any real money, if you decide you did want to, you know, use this to hedge. But I think that's it. So, hope you learned something. Hope this helps. Have a great day. Bye-bye.